Every big retailer says the same thing when times get hard. Costs go up, shoppers pull back, margins get squeezed, growth slows. In most cases, that story ends with store closures, weak sales, and a long slide into decline. Dollarama took that same pressure and turned it into power. By the end of this video, you'll know why this works and how to apply it with what you already have. On the surface, Dollarama looks simple. Bright stores, cheap goods, fast trips, low prices. But under that simple look is one of the most disciplined retail machines in Canada. According to Dollarama's second quarter reports for 2023, the company operated over 1,400 stores across Canada. Market analysis in 2023 put its share of the Canadian dollar store segment at about 81%. In fiscal year 2023, Dollarama reported revenue of $1,534 million Canadian dollars, up about 17% year over year, according to the Dollarama Annual Report 2023. That is not the profile of a chain barely surviving on cheap goods. That is the profile of a company that figured out how to dominate a category. The first clue is in the company's origin. Dollarama is based in Montreal, Quebec, and the first store opened in Montreal. Larry Rossi founded the company after earlier building and selling a successful discount store chain in Quebec. In 2009, Dollarama acquired the rights to the name and concept following the bankruptcy of the former Dollarama chain. That moment matters because it shows something people often miss. Dollarama was not built as a random bargain shop. It was built by someone with direct experience in discount retail, and then rebuilt around a known concept at a moment when the market gave it an opening. Growth came fast. In 2010, Dollarama opened its 100th store in Canada. By the end of the second quarter of 2023, it had grown to over 1,400 stores. Then came the next signal that this company was thinking far ahead. In 2015, Dollarama launched an online shopping platform. In 2017, it officially traded on the Toronto Stock Exchange under the ticker DOL. In 2023, it announced plans to expand to 2,000 stores by 2027. That is the part many people get wrong. The common belief is that dollar stores are small-time businesses that win only because they sell cheap stuff. The evidence here points in a different direction. Dollarama is not acting like a weak retailer clinging to low prices. It is acting like a national system that plans years ahead, raises capital, builds scale, and keeps expanding even when inflation is rising. Its store network is a big reason why. Research notes say Dollarama often places stores in community shopping centers that drive foot traffic. That sounds plain, but it is a smart move. Community shopping centers are where people already go for everyday needs. A store does not need to create traffic from scratch if it can sit where traffic already exists. This supports fast visits, repeat visits, and routine buying. It also helps explain why Dollarama became so hard to ignore across Canada. When a chain is present in the places people already visit each week, the brand stops feeling optional. It starts feeling built into daily life. Then there is the product strategy. Dollarama offers a wide variety of goods priced at $4 or less, according to the research notes. That price ceiling matters a lot. It creates a clear mental promise. Shoppers walk in expecting limits they can understand before they even pick something up. They do not have to guess whether the store is aiming at premium buyers or bargain buyers. The answer is obvious as soon as they enter. Larry Rossi described that idea in a National Post interview when he said, "Success in retail is about giving our customers more for less every single time they walk through the door." That line sounds like standard retail talk. But paired with the company's numbers, it becomes something else. Over 1,400 stores, about 81% of the Canadian dollar store segment, $1,534 million Canadian dollars in fiscal 2023 revenue, more than 20,000 employees across stores and warehouses in 2023. This is not just branding. It is a system that has been repeated at national scale. Dollarama also widened its appeal over time. In 2021, it introduced new product categories, including seasonal goods, which helped attract a broader customer base. That move matters because it pushed the company past the old stereotype of a dollar store serving only the most price-sensitive shopper. Seasonal categories bring in people who might not come for basic household needs alone. Once they are in the store, the brand has a chance to become part of more shopping habits through the year. This helps explain a change in how Dollarama fits into Canadian life. In weaker economic periods, bargain shopping becomes more attractive. The research notes state that as of 2023, Dollarama continued to outperform several retail counterparts, and that the shift to a bargain-centered shopping experience was seen as a strategic advantage in tougher economic climates. That is a polite way of saying the company was built for bad times as much as good ones. And then came the pandemic period, which gave Dollarama another edge. Research notes say Dollarama was one of the few retailers designated as an essential service during the COVID-19 pandemic, allowing it to remain open while many other stores closed. That was huge. When other chains had to shut doors, Dollarama stayed active. That kept sales flowing, kept shoppers coming, and likely strengthened habits that lasted after the strictest disruptions passed. If a store is open when people need basics, it becomes more than a place to save money. It becomes dependable. There is also a less flashy part of the story that matters just as much. Dollarama's stores are designed to be minimal and efficient. The research notes describe a minimalistic store design that emphasizes efficiency. That is not about looking fancy. It is about moving people through the space, keeping operations simple, and supporting a low-cost model. Fancy displays cost money. Complex layouts cost money. Retailers that try to impress with store design often pay for it in ways shoppers never see. Dollarama goes the other way. The supply side follows the same pattern. The research notes say Dollarama has a reputation for creativity in sourcing products that fit within its low price plan, often working directly with suppliers for unique goods found only at its locations. That detail is easy to overlook, but it reveals a lot about how the company protects itself. If a retailer can work directly with suppliers and shape goods around what its stores need, it gains more control over cost, assortment, and differentiation. Unique goods also give shoppers a reason to come back because they are not always seeing the exact same selection they can find elsewhere. This is where the company's evil genius really starts to show. Not because there is secret magic behind the yellow signs, but because Dollarama removes friction at almost every stage. The store format is simple. The pricing promise is clear. The locations are built around existing traffic. The sourcing is tuned for low price selling. The category mix grew wider in 2021. The chain stayed open during a period when many retailers were closed. Each move on its own looks ordinary. Together, they create a machine that is hard to dislodge. And the leadership story matters too. Brett B. Smith, the current chief executive officer, has led expansion efforts and strategic growth in the Canadian retail market, according to the research notes. He described the company's growth strategy this way: expansion isn't just about numbers. It's about commitment to our customers and communities. That quote can sound soft compared with the hard numbers, but look closer and it fits the playbook. Store growth is not just a race for bragging rights. In a country as large as Canada, reach matters. Convenience matters. Presence matters. If a shopper knows there is likely a Dollarama nearby, the chain gains a place in that person's routine. Expansion, in that sense, is not only about opening doors. It is about becoming familiar. Still, no story this big comes without criticism. Dollarama has faced backlash over wages and working conditions. Critics argue that retail workers should earn a living wage given the company's profits. That criticism is part of the story and cannot be brushed aside. A company reporting $1,534 million Canadian dollars in fiscal 2023 revenue while employing over 20,000 people will face tough questions about how the gains are shared. The company's defense is also clear in the research notes. Dollarama argues that it provides affordable goods that help low-income Canadians, while also contributing to local economies through job creation. This is the tension at the center of the brand. For many shoppers, Dollarama is proof that lower prices still exist. For critics, the same company raises questions about labor standards in discount retail. That tension is one reason the company gets misunderstood. A lot of people want one simple answer. Either Dollarama is a hero helping households stretch their money, or it is a cold profit machine built on low-cost labor. The evidence says the reality is harder than that. It is both a source of affordable shopping and a target of labor criticism. Those two facts can exist at the same time. There is another belief worth challenging. People often assume Canadian retail is easy prey for giant foreign chains with bigger size and deeper pockets. Yet Dollarama's position suggests scale alone is not enough. A company with about 81% of the Canadian dollar store segment in 2023 is not winning by accident. It is winning because it built local reach, a clear low price identity, a disciplined format, and a sourcing model tailored to its business. And the company is not standing still. In 2023, Dollarama announced plans to reach 2,000 stores by 2027. That tells you management sees more room to grow, even after passing 1,400 locations. Most weak retailers do not announce expansion on that scale. They cut back, get cautious, and shrink. Dollarama did the opposite. When you step back, the pattern becomes obvious. Founded in Montreal by Larry Rossi. Rebuilt around the Dollarama name and concept in 2009. 100 stores by 2010. Online shopping launched in 2015. Public trading in 2017 under Dial. New categories in 2021. Over 1,400 stores by the end of the second quarter of 2023. Revenue of $1 billion. 534 million Canadian dollars in fiscal 2023. About 17% year-over-year growth. More than 20,000 employees. Roughly 81% of the national dollar store segment. A plan for 2,000 stores by 2027. That is not a random streak of good luck. It is a long series of decisions that kept building on each other. So why does Dollarama rule Canada? Because it made itself easy to understand and hard to avoid. Because it scaled faster than most people noticed. Because it placed stores where daily traffic already existed. Because it kept a price promise simple enough for shoppers to trust. Because it expanded categories without losing its identity. Because it stayed open when many stores could not. Because it built enough reach to become part of normal life. The average shopper sees a bargain store. The numbers show a national power. That gap between appearance and reality is the whole story. Dollarama does not look like a retail empire in the usual way. It does not sell a dream. It does not wrap itself in luxury. It does not ask to be admired. It asks to be useful. And in Canada, that has turned out to be a very powerful thing. That is the real genius behind the chain. Not flashy branding. Not hype. Not mystery. Just relentless control over the parts of retail that matter most. Price, location, reach, repetition, habit. And once those habits are built across more than 1,400 stores, with about 81% of the segment, they become very hard to break. Dollarama did not just survive hard times. According to its fiscal 2023 results, it grew through them. For a chain that many people still treat like a simple discount shop, that might be the smartest trick of all.